Good morning, good afternoon, and good evening, everyone, and welcome to the Winter 2025 M&A Bootcamp. My name is Colin Mahan, and I'm a program director at the Nasdaq Entrepreneurial Center. And for those of you who may not know, the Nasdaq Center is a nonprofit that's building a better path for entrepreneurs worldwide by improving access and knowledge for all in entrepreneurship. As you're going to see in the chat in just a moment, the Nasdaq Center provides programs, resources, and exceptional mentorship to entrepreneurs across all races, industries, and geographies. So check out those links and resources in the chat. We're going to open up for live Q&A near the end of each panel, so please submit those questions for us in the Q&A function at the bottom of your screen throughout each session. We'll try our best to get to them all. Now, none of what we do here at the center would be possible without all the amazing support from our sponsors, including Nasdaq, Lehigh University, KPMG, Wilson Sonsini, Wells Fargo, the Nareed Foundation, Walmart.org, JP Morgan Chase, BPM, HubSpot for Startups, and Google Cloud. We're humbled by their contributions and hope you're grateful too. Before we get started, I'm going to launch a few polls to take a step back and take a temperature gauge on how everyone is doing today. The first poll is, how are you feeling about your business? So just launch this really quick. How are you feeling about your business right now? Are you optimistic, in survival mode, feeling a little anxious? Let us know. We use this to guide the wellness programs we provide for you, the entrepreneurs that we serve. So thank you for participating. Let this run for another second or so. All righty. Well, looks like optimism is in the lead, but there is a decent mix of survival and anxiety out there. So we will get to work on hoping to help you feel a little bit more optimistic about your business. The second poll I'm going to launch is, what side of M&A are you looking to learn about today? Are you looking to learn about the buy side? Are you looking to learn about the sell side? Let us know. This will help inform our panelists where you're coming from. Oh, this looks like it's a pretty clean 50, almost a 50-50 split. All righty, I'm going to let this run for a second. Wow, I think this is the first clean 50-50 split on the buy and sell side. So you're in for a treat because we have both of those conversations covered today. So I'm going to cover our agenda, as I just mentioned. We're going to kick off the program with a market update, and then followed by a panel for M&A strategy for early to mid-stage entrepreneurs. So that's you on the sell side. We will have a quick 5-minute break and then transition into our last panel where our experts will share their knowledge on growth through acquisition, our buy-side overview and insights panel. So please note, the same Zoom link will be used for both sessions. So without any further delay, please join me in giving a warm welcome to our first presenter to share the M&A market update. JP Diddy is a managing director at KPMG. JP, welcome.
Hi, great to see everybody. Thanks, Colin.
All righty, thank you. Over to you.
Okay, well, appreciate everyone joining us this morning. Thanks to the Nasdaq group for putting this together as always. Anything I say today is purely from a financial perspective, has nothing to do with a political perspective, right or left or blue or red or anything along those lines. I've been a managing director for the last 25 years. I actually started my career as a corporate tax attorney. I thought that'd be a long-term miserable existence for myself. So I went off to business school and started with Hamilton Quist, which probably a lot of people don't even remember on this call, but started with them in San Francisco and spent the last 25 years in M&A, particularly around software. So pleasure to meet everyone. I'm going to kick off with a quick U.S. market overview. Next slide, please. So from a market overview perspective, 2021 was really a watershed year from a volume and value perspective. I think we're all aware of that. That's pretty far in the rearview mirror at this point. 22 and 23 were certainly down years and a pullback from that 2021 high watermark. And then 2024, we had a nice recovery, really driven by easing inflation, lower interest rates, rising investor confidence. And I believe that many of us are or were hoping to continue that momentum into 2025 I think certainly from a November 6th perspective, there was a lot of optimism in the U.S. market from a business perspective, from a certainty perspective, leading into the new year. At least in my conversations, I do think that has waned a little bit over the last few weeks, just based on the same things that drove us in 2024. Where are we on inflation that's ticked up a little bit? Where are we in interest rates? The Fed seems a little paralyzed right now with respect to what's going on in the political arena. And then investor and consumer confidence seems to be waning a little bit, probably tied to the inflation. And then also employment, which we'll touch on here in just a little bit, although it's at 4%, which is pretty near our all-term lows. Sorry, I just saw the audio comment. Let's see if I can turn up my volume. Anyway, the fact that interest rates are at 4%, almost all-time lows, although we all are seeing a lot of federal government employees being terminated at this point, which is, again, that's a financial comment, not a political one. So we're hopeful that both transaction volume and IPO volume will increase in 2025. That's still yet to be seen. From an M&A perspective, on the top chart right there, private equity activity actually is down through February, down almost 53%, which is pretty phenomenal drop. I know there's been a lot of optimism about M&A coming back from a PE perspective, but we'll have to wait to see how that plays out. And again, I think that ties back to the uncertainty we just talked about. The other side of that coin is that IPO volume is actually up. It's up 60% from last year. Again, we only have 2 months into 2025, so we'll have to wait and see how that plays out. But the volume itself is up significantly, although proceeds are only up about 14%. So we're getting a lot more deals, but lower raises on those IPOs. Next page, please. From the U.S. market by the sector perspective, these tended to stay pretty consistent, both from a value and volume perspective over time. Obviously, some sectors come and go a little bit. I do think, as you'll see in the bullets on the left, there has been a lot of demand for critical materials. I don't think that's probably a surprise to too many people. There's a lot of demand, obviously, for chips, whether that's AI or energy, cars, defense. But the chip sector is off the charts, obviously, where a lot of investors are waiting for NVIDIA earnings coming out today. NVIDIA is obviously the kind of bellwether from a chips perspective. But just the whole mining and energy and resources is obviously topic of mind around the world. I think we all saw that Zelensky's coming to the U.S. this Friday to sign a minerals deal with the United States. I actually saw an article yesterday that talked about the potential for mining critical materials on the moon being a multi-trillion-dollar potential industry. With obviously some downsides associated with that, but as we can all imagine, the cost of mining on the moon would be probably pretty off the charts. But overall, I'd say that the mining, as we just talked about, is up, but everything else tends to be pretty consistent over time. Next slide, please. Multiples by sector. The first column there is technology. That's where I spend most of my time, so that's probably where I have the most value add here. I think 21 and 22 were very high watermarks from a revenue perspective. I represent private companies every day from an M&A perspective, and I think sellers, founder owners who are finally selling their companies are starting to realize that we may not get back to the 2021, early 2022 multiples. I think we're all very aware of the thought that you can't time the markets. But I do think in that first column, from a technology perspective, one of the most interesting insights to me, at least, is that the former mindset of growth at all costs and a revenue multiple vision of the world is waning a bit, and the fact that companies that are EBITDA positive and potential buyers and sellers are focusing more on the EBITDA multiple perspective. So you can see that although the enterprise value multiple for revenue has come down, the EBITDA multiple has gone up very significantly over the last 3, 4, 5 years. So I think that's pretty interesting. From a financial services perspective, certainly volume is down materially in that sector. Healthcare, consumer, energy and materials, and industrial, if you look at that, looks really consistent over the last several years. So next slide, please. From an M&A financing and private equity capital perspective, global fundraising, which also reached its peak in 2021, has come down over the last several years. I actually think that ties very closely to the global dry powder slide below. There's so much dry powder still on the sidelines that a lot of big funds that raised, 4, 5, $10 billion, they haven't deployed all that money yet, so there's no need to go out and continue to raise new capital. There is a corollary to that, which is also the fact that because they have not had many exits over the last few years, a lot of the LPs are on the sidelines saying, hey, until we get some returns from you, Mr. GP or you, Mr. Fund, we're not going to put any more capital to work for your next fund. So I think hopefully that will be a little bit of a catalyst for some sell sides from the investors over the last couple of years. The global dry powder, this is what we talk to our clients a lot about from the perspective of going to market from a sell side perspective. I personally think if you're a B minus, C plus, C company, you're probably not going to have a good outcome if you go to market. But if you're a B, B plus, A minus, A company, you have good growth, you have good total available market opportunity, you have a good management team. All those things are going to do well for you from a sell side opportunity. We had our last couple of deals, we've had 22, 23 IOIs from an indication of interest perspective. So I think with all that dry powder, the P's are going to be the biggest M&A buyers going forward. Cost of debt perspective, I think this is interesting from the at least from a mental perspective. If you look at over on the right, we're pretty much at our averages for the last 11, 12 years. There's just this from 2020 to 2022 where we had 0 federal funds effective rate. That is a mindset that for a lot of us is hard to get out of our heads. But hopefully the private equity groups who use debt leverage when they're buying companies, they're kind of back to that mindset of, hey, okay, we're kind of at our norms, because I think most of us could probably agree that 0% interest rate is not a long-term sustainable opportunity. Finally, the last page, just to wrap up. Things to consider for 2025. We're still only February, so let's see where we go from here. It's still early. I already mentioned that business optimism was very high at the end of the year, given the certainty at least with respect to the election. Based on some of the things that are going on now, we'll just have to wait and see how that turns out over the next few months. The direction of inflation and interest rates is certainly a concern for investors and buyers. Although inflation is ticked up slightly, the long-term average is still 3.28%, and we're at about 3%, so we're still below that. As I just talked about on the last slide, interest rates are pretty much at our norm. So even though they're not the 0% we talked about from that 2020 to 2023 period, they're still relatively consistent over the last long term. Persistent low employment rate, 4%. That's almost an all-time low. The all-time low is about 3.4%, which we're 20 points off of, or 20% off of. But that is probably going to tick up based on what's going on with in the federal government. Given that the federal government is the largest employer in the U.S., there's a lot of terminations happening, as we've all seen. Impact of the tight credit markets, that certainly affects buyers from a leverage perspective. We talked about buyers focusing on profits versus growth at all costs, which we saw in that chart. Hard landing versus soft landing versus growth. And then coming into the year, we were all focused on growth from an economy perspective. I think we've all, or a lot of us have changed our minds a little bit, kind of waiting to see whether we're going to end up with a hard landing or soft landing. And then certainly the current political environment, which this all ties into pretty closely, will affect the inflation, interest rates from a business perspective, and then also the global positioning of the U.S. as a leader from a financial perspective in the U.S., what's going on with NATO, Middle East, Ukraine, all those things will be tightly wound into how things play out over the next 6, 12 months, 2 years, 4 years. So that's the overview. Colin, back to you.
Amazing. Thank you, JP, for that market update. And we will continue to look at what's on the horizon over the next couple of months. But really appreciate you sharing your insights today. Before we jump on to our next session, I'm going to launch another quick poll to let us know how many of you are looking at or interested in M&A in the next 3 months. So are you fully looking into it? Are you not ready yet? Are you just here to learn more? Let us know. Thank you for participating. Alrighty. It's kind of going. End this poll. Share those results. Thank you for voting. Looks like a pretty good mix. Some of you fully looking into it, some of you not ready yet, and many just looking to learn more. So you're in for a treat because our next panel is M&A strategy for early to mid-stage entrepreneurs. So please join me in giving a warm welcome to our moderator, who's Donna Pawar, who's a Chief Product Officer at Veritempo and a Nasdaq Entrepreneurial Center Advisory Board member. We have Catherine Riley-Sapori, who's a partner at Wilson Sonsini, John Milner, who's a principal, deal advisory and strategy at KPMG, and Kevin Giselle, who's a head of company solutions at Nasdaq Private Market. Team, so happy to have you. Donna,
Yeah.
over to you.
Thank you, Colin. I'm super excited. We have a brilliant panel today and looking at all the optimism, both from the audience poll, which I was really happy to see, as well as JP's business optimism. I think this is a great way to kick us off. I'm going to just start with having my fellow panelists introduce themselves, and I can just do a quick intro for myself as well. I'm Dana Pawar. I have been with the center for 10 years as an advisory board member. And I also have been very lucky to be part of many exits of many tech companies. And I currently run Veritempo, where we work with startups from ideation to launch, and also on investments in M&A. So with that, I'm going to have Kevin introduce himself.
Thanks. It's great to be here today, everyone. My name is Kevin Gazelle. I am a managing director and head of company solutions at Nasdaq Private Market. What we do is we work with private companies as they grow and are navigating the private landscape and thinking about exit strategies. The majority of the world we live in is in the secondary world, but we also work with private companies in the capacity of M&A transactions as well. And that starts as early as Series A companies all the way through late stage.
Thank you, Kevin. Catherine, do you want to go next?
Sure, happy to. I'm Catherine Riley-Zapori. I'm a partner in the New York office of Wilson Sonsini. My practice is centralized around corporate and M&A transactions. I've been at Wilson for going on 8 years, and prior to that, practiced at a couple of different firms, all working primarily in the private company space and M&A. I do dabble occasionally in public deals, but the vast majority of my practice is on the private side.
That's awesome. John.
Yeah, absolutely. Good morning or good afternoon, everyone. Super excited to be here. I'm a partner in KPMG's deal advisory practice, and I also co-lead our diligence practice for the technology sector. So hopefully very relevant to this particular audience here. My practice is really to help buyers make the right deal, to help companies drive value during that period, and then have a successful exit. So super excited, looking forward to this great conversation.
Thank you. As you all can see, we have an amazing panel, and we also saw that from JP again, M&A market is seeing an uptick. Saw an uptick in 2024. IPO volume has up significantly. So I think we're right place, right time. With that, I'm going to kick off our panel with Kevin. So Kevin, the average tech M&A deals, as we know, can take anywhere from 6 to 12 months and often even longer. Can you walk us through a typical M&A process for a tech startup? Also, if you can just talk a little bit about where Nasdaq Private Market fits into this process and how it benefits early stage companies, that would be great.
Yeah, thanks, Donna. And maybe I'll just start there. So again, we're interacting with private companies starting in a fairly early stage. The majority of the world that we live in and where we are helping most of the time is helping provide liquidity to those private companies, right? So a private company is always thinking about, their exit strategy, but along the way, right, they also have to solve for liquidity needs before they go public or get acquired. And so the world we live in is, again, interacting with those private issuers. That's the team that I run. We're talking with those private companies. Typically, it's the management and the C-suite, understanding what their needs and goals are, and also helping to connect them with strategic investors in the market as well. So as you mentioned, the life cycle obviously is different for everyone. And I think, that can certainly be 12 to 18 months is probably, the typical timeline, so to speak. And there's a lot of different phases, I think, that are encompassed in that time frame. So I think the first is, right, just thinking about a strategic plan, which is going to take some time, kind of as a step one. Understanding what is your strategy for getting acquired in terms of how does that correlate with your long-term business goals. And look, and everyone wants to, everyone's at a different stage of their life cycle and has different size and scale. But I think you want to have some folks really focused in this matter. So like a deal team, if you will, to kind of really think and strategize about this plan. And look, that deal team might just be 2 people to start, and it might grow and be 3, 4. You'll start to leverage outside partners as well, which we're going to get into a little bit later. So that's kind of the step one. And then, understanding, as a company, who's a potential acquirer for your business as well, right? And looking at, this is a company that has acquired other businesses like us. So doing that due diligence as well is going to take a few months typically. And then even having, potential, pre-diligence meetings, if you will, with those potential buyers, just to introduce yourself, right? And just to network. I think that's going to be a huge part of this. We're probably going to talk about a lot as far as just the networking as much as you possibly can. And then the negotiations may kick in, which may also take, a month or two, just going over basic terms, valuation, all those kinds of things. And then also encompasses probably what would be like the due diligence phase, which, again, could be anywhere from 1 to 3 months where, someone's going to most likely do a pretty comprehensive examination of your assets, your financials, your operations, even looking at legal matters. I'm sure Catherine can talk about that in much greater detail. And then if you're starting to have some data that's going to be shared, right, you probably want to think about hosting data in a secure environment. So where are you going to, host the VDR? And then after that, right, it's then going to get into more of like the deal structuring. So the deal structuring phase, again, maybe a month, maybe a little bit longer, but finalizing those terms, addressing any potential regulatory issues that could be or you could foresee. And then it's going to be a matter of the closing of the deal, which could take a few weeks, but signing the agreements, transferring of obviously ownership and completing the transaction. And then it's kind of the post-merger stuff, right? Which is kind of the last phase, which is certainly an ongoing piece. I don't know if there's never really a cutoff for that, right? But you're going to have to implement, an integration plan for tech, for operations, for culture too. Again, that's going to be kind of on an ongoing basis, but I think it's important to understand that the timeline can vary significantly based on factors such as deal size, regulatory requirements, and obviously the complexities of the negotiations.
Oh, that's great. I agree. I think the key takeaways here really are start early. It takes time. It takes much longer than you actually think. And it's like a marriage, people say, right? You date, you date, you date. So you network, you network, you network because you're in this for the long haul. So start early and just network. So I
Right.
love it. Thank you so much. That's an awesome way to kick us off. Catherine, I'm going to move a little bit on the pre-sale prep. Kevin alluded to diligence or due diligence being so critical. And as you know, a significant percentage of M&A deals encounter legal issues during due diligence. Based on your experience, what are the most common legal landmines to avoid? And how can a startup address these before a deal process even begins?
Great question. So this is one topic that I love to talk to founders about as you're starting down the process of thinking about doing a deal, because there's so much that can be done in advance, and there's so many traps to be wary of as you're proceeding down the pathway of having those conversations, potentially engaging a banker, thinking about those different things. So the first thing I would say is make sure that you don't necessarily have to be teeing up a data room or anything. You may want to, but make sure that you're organized and that there is someone at the company who knows where all your documents are, who knows how to find things from going back in the history of the company. Often that person will be the GC or someone else in the legal department. But if you're an earlier stage company, you may not have a GC. And so tasking someone with that more organizational role, sometimes thought of more as like the company secretary, but it doesn't need to be that formal, right? Someone who knows how to track the documents, is maintaining it somewhere, so that when you do prepare a data room, you can do it quickly. Often the data room becomes the long pole of the transaction, especially early on in the transaction. And it's really surprising how often that can cause friction and frustration where it doesn't need to be at all, very early between the parties. And if you are able to just, turn the switch, open the data room, have all the documents there, it really sets the tone for a really positive transaction and lets the buyer know you're in charge here. You've got this under control. They don't need to be super concerned, right? If you're really disorganized, that immediately starts sending up red flags that, hey, this is going to be a rough diligence process. We need to be preparing for that. The other one I would say is a lot of times as folks start to prepare to wander down the path of a potential acquisition, if it's not definitely the path you're going to take, it's just something that you're exploring. A lot of times people will try to cut costs and keep the process as lean as possible early on. And I would really strongly advise against that and bring in your advisors. Bring in your legal counsel, your outside legal counsel, bring in your tax advisors. If you're working with a banker, engage that banker, involve them in all the discussions that you're having and the strategy that's going on. And the more that people are involved early, the better you are set up with a good foundation for the transaction to progress. There are ways to work around things like deferring legal fees or setting up a specific fee structure. A lot of the firms, including ours, that work with startups and early stage companies have formats for paying legal fees in connection with a deal and how you can make those arrangements, especially if it's not a deal that you're certain you're going to pursue. But we see so many instances where we're brought in too late. And that's not to say that we can't, kind of help turn things around and negotiate around the edges where we can. But especially at, having conversations around NDA negotiation, term sheets, definitely term sheets. If you don't have legal counsel involved at the term sheet stage, you're going to get into some real trouble. And it often can be too late to renegotiate some of those points if they weren't brought in early.
I think that's great. And thank you for highlighting the fact that, there are ways for startups to work with legal, not without paying everything up front, because I know that's always a concern. How can I afford this today, right? I'm just thinking about it. So that's really great. John, I'm going to stick in the same due diligence mode. I'm going to switch a little bit, though, to financial due diligence. We talked about legal, and that is also, a really critical phase, right? Especially where any red flags can derail a deal. So what should founders expect during a financial due diligence process? Are there any specific steps they should be taking or thinking about to ensure their financial records are in order and to minimize any potential disruptions or delays during what is already a very long process?
Yeah, absolutely. And I'll group tax in there too, because everything numbers. I like to think about numbers with accountants and little words with attorneys. Um, Being prepared is the number one thing. You mentioned it just a moment ago, disruption. And any sort of M&A, any capital raise is an incredibly disruptive process to a company. You've got to run the business as a founder or management team. And any new owner or investor really wants to make sure that you're driving that business forward. And then you've got to do all this other work to try to get a deal done. And for us, it's a full-time job. And for you, it becomes a full-time job. But you also have another full-time job. And so preparation becomes key. We're seeing, especially it's historically done in much larger transactions, but we're seeing it move into much smaller transactions over the last few years, this concept around pre-sale due diligence. So as you're starting to get ready for a transaction, you actually bring in your advisors, and this is a theme you're hearing, earlier on to actually do due diligence on you. So you figure out where the opportunities and the weaknesses are. And the great thing with that is you can actually give that information to your potential buyers. It actually helps make that diligence process run much smoother. And one of the most important things it does is it helps you maintain control of the narrative. One of the things that you need to do through your sale process is controlling the narrative. As much as possible, you want to get ahead of what the value points are and what the risk points are. And so you're thinking about those. And that kind of going through that pre-sale diligence process is really important. It's helpful. You do it once instead of once with every single buyer that's coming through. Yes, every buyer is still going to do their own diligence. They're going to ask incremental questions, but you're giving them the base to go do that, and it helps you move faster. It helps you control the process and the narrative, but it's going to be a disruptive process. So being prepared early, not thinking, hey, we like you, we've done the networking, we've done the dating, we think we're at a good valuation, let's move forward. And then you get pages of request lists. And you've got to go find the legal documents and the finance documents and the tax documents and the IT documents and the HR documents. Get ahead of that.
Yeah, I think again, preparation is the key. Start early. Yep. I'm going to ask the next one to the group. Let's have some fun with trends. And we did see JP talk about, we've seen fluctuations in M&A activity with recent reports indicating shifts in deal volume and valuations. So again, this is to everyone on the panel. What are some of the current trends that you are seeing in the M&A market that early stage founders should be aware of? And I'm also going to go there. I'm going to go down to the AI path, right? Especially today, we've seen a surge in AI-related acquisitions. How is AI impacting this M&A landscape, both in terms of target companies as well as the due diligence process itself? And we'll talk more about the process as well. Who wants to go first?
Yeah, I mean, look, I think, Donnie, you said it. I think the AI, I think, is probably at the core of all this. I think that's driving a lot of the demand for, software and maybe semiconductor companies. So I think this is we're gonna continue to see, obviously we're seeing these valuations that are pretty impressive, right, on the AI side, and a lot of different companies that are AI enabled or, solely focused in AI, but ultimately, it's going to come down to obviously a lot of consolidation with these companies. And certainly there's going to be a lot of winners in the market, but there's going to be a lot of consolidation overall where a lot of these are going to just become target acquisitions for some of the big players in the market. So I think that's at the core, right, of everything. It's going to be the biggest driving factor. And again, just the increased valuation of these AI-focused companies are just, companies with strong AI capabilities overall, right, are just becoming much more attractive acquisition targets. And, everyone's trying to get how do you increase your, technological capabilities, right? How do you get better? How do you get faster? How can you get something that can do the work of multiple people and do it with great accuracy? So I think that's at the core of obviously what's going to be driving a lot of this.
Yeah. I kind of think about it in a couple different ways. Getting back to what JP was talking about earlier on in terms of what we're seeing in a little bit lower level of volume in M&A, we're all talking about M&A, which we collectively sort of think about as an actual sale of a whole company to somebody else. But because companies are staying private longer, you're seeing a lot more growth equity. So it feels like M&A. We're Series D, E, late stage, really big checks. These would have been the checks that people would have bought a company with, but instead they're buying a minority share. That process looks very similar. You're going to go through the same level of diligence, the same level of negotiation. You're just not selling the whole company. You're still managing the business, but now you've got 2, 3, 4 really large institutional investors behind you. So I'm seeing much more of that happen because companies are staying private later and they're increasing the valuation in the hot areas. AI, it's clearly very hot. So great valuations for AI companies. But back to something Kevin said very early on, which is you got to sort of know who might be an investor or a buyer of you, because the other side is true, which I've started to see in some of my larger corporate clients, which are, I've got to go take the capital I have and invest it in CapEx to compete with my AI tools, which took away dollars that I would have had to go buy a company. And so your buyer population may actually be changing as a result of AI. It's an interesting dynamic that we're starting to see.
Yeah.
I agree. Catherine, anything you want to add there?
Yeah, well, one thing I'll add is we are definitely seeing a hot market with respect to AI, but there's also, especially amongst larger buyers, a very cautious market, right? People are starting to understand some of the risks around AI and some of the pitfalls, some of the weaknesses in companies that say that they're AI companies, and what does that really mean? And what are they doing as part of their programming that could be potentially risky down the line? There's also kind of, quite a bit of uncertainty as to how those risks are all going to unfold. For the most part, buyers who are interested in AI companies understand those risks and are willing to take them on. But there are some things that can make, acquiring an AI company riskier than others. And so just being aware that there are a lot of questions around it. And Donna, you had also asked a question about process. How is AI changing the process? And this has been an interesting one for us on the legal side, as some people are starting to broach the idea of using AI for particularly legal due diligence. And how does that unfold? And it's been interesting because where AI is still falling short, particularly in things like contract review and otherwise, is in the nuances. And in those, odd bespoke cases and the terms that maybe you don't see very often, but could be quite problematic. And so we are still seeing that for the most part, the things that you care about don't want AI being the one that is doing that review. That will probably change. AI is getting better by the day. But for now, still being cautious about AI use in diligence and review and understanding the potential weaknesses there as well.
Yeah. And maybe if I might add something on to that, because it's a great point. KPMG recently released its 2025 M&A Outlook, which we surveyed more than 300 executives in M&A. And one of the questions was, how are you using AI throughout the M&A process? And the majority of respondents said, we're using AI in some capacity throughout the M&A process. And then when we double click and we say, well, okay, where are you using it? The vast majority of it is in post-acquisition, deal value creation. So how do we go read a bunch of contracts to mash them together to figure out the best rates after we own the company? How do we do a lot of that arms and legs work? It might be legal, it might be operational, but the respondents in terms of pre-deal use of AI was very low, exactly for the reasons Catherine mentioned. The points that matter, M&A is very disruptive. It's a huge transformational purchase. You don't just trust that to the machine, at least yet.
Mm-hmm.
If I could not also just, I'm sorry, and this is very quick and brief, but just to double click on what John said a little while ago in the growth equity phase and kind of maybe taking that a step further, because I completely agree with that trend, right? Because we kind of see that in the next phase as well from the secondary side. We're seeing obviously a ton of money that's being pumped into private companies still. And, obviously valuations are creeping back up. I know we had this correction in 21. But with that, right, companies, to John's point, continue to just stay private for a very long time. And so a lot of times on the heels of these large growth equity rounds, and you're bringing in strategic investors, there's also then a secondary component for people to, right, take some chips off the table, take some risk off and get some liquidity. And so that's right now, just to be very frank, in the market, we are seeing just an absolute boom of these types of transactions and these secondaries. Again, a lot of times where it's a primary that bleeds into then a secondary on the heels of that. So it's a great point, and it's a very, very active market. And we're also seeing M&A transactions as well for some private companies that we work with, where they're getting acquired or looking to acquire someone, and then even on the heels of that, there's a secondary component. So just wanted to add that to John's.
That
Yeah.
is a great point. And I think that's something we forget, right? When we talk about M&A, we always forget about the secondary markets. And I love that you brought that perspective. And also, I love that all three panelists had the same view, right? There's so much hype around AI, and like right now, there's nothing but AI that everybody talks about. I've been to an event. I was at an event recently. It was about like it was chefs presenting their food, and someone was like, Was there AI involved in this?" And we're like, "Wait, what?" I mean, there's just so much ridiculous hype. So I'm glad that you have more of a normalized view that yes, it's definitely there, but very cautious. It's going to take a while to get to where everybody's saying it is, both from a tools process perspective as well as from an acquisition perspective. So I think that's great. Kevin, I'm going to stay with you a little bit on the next question. John alluded to this already about how critical it is to find the right potential acquirers. I wanted to ask you, from your perspective, what are the most effective ways for founders to identify and connect with potential acquirers? And how can they position their company as an attractive target, right?
Yeah.
Especially in this light of increased competition,
Yeah.
as well as all the hype around new technologies.
Yeah, it's a great point. And right, at the core of it is like, right, how do you stand out? Right, how do you stand out as like being like, right, like a puppy in a puppy litter when everyone comes to see the puppies and everyone's jumping up and down and you want to get noticed? It's like, it's right, it's the same kind of concept for some private companies. And so we talked about the networking piece. I said it earlier, and I think, again, that's at the core of it. So attending conferences and industry events, and look, maybe that's trade shows, but sometimes the ROI you might feel isn't great. But I think you have to do some of that diligence, right? You're building relationships, and you want to, again, build relationships with strategic companies that are like in your space. So larger companies, right, that are in your space and are a little bit later stage. And you want to do this right, years ahead of time, right? So I think it's never too early to start those discussions and obviously start to nurture those relationships. And then it's all about, right, what's your value proposition, right, as a private company, right? How can you identify and articulate what that value prop is? And then how are you showing that you as a private company, as a startup, can solve a specific problem in the market and help other companies and individuals enhance their capabilities? And so, I think quantifying that is also really critical as well. And you have to use real data, real metrics to do so, right? You can't just do so with like a really flashy slideshow. And then I think other just key pieces, really focusing on the really like the scalable, more sustainable growth overall. So like, again, developing a business model that, can grow without, obscene increases in your costs. And so, really achieving consistent growth, I think, is really important throughout the life cycle. And that's just being able to show that, right, there is more potential for future expansion and market penetration as well. It's an important factor, right? So it's not just topping out and then being like, where do we go from here? It's understanding we can get to this point A, B, point C, but being able to kind of articulate that growth story is really important. And then I think, look, you have to invest in thought leadership, and I think there's a piece of it that you have to invest in marketing, to be honest with you too. So having a budget set aside for that, I think, is really, really critical as well. But again, I think at the core of it, you have to understand like what are going to be the motivations of a company that might acquire you. So again, I think you can never do too much research on companies that might be someone that likes your business, that have acquired other companies like your business. And then so I think that's really critical, just so you're prepared, how your company, your startup fits into this potential, acquires long-term strategy. But I also think the last thing I'll say is like, I think you also have to, really important to maintain this balance, which maybe can be difficult, of showcasing your company's value, but not with like too much zeal, right? Where you seem desperate at any point as well. And so I've had conversations with folks who are at this phase of maybe looking to get acquired because they don't see an IPO and they want to go out there and they want to sell their company, but they also don't want to come across as seeming too desperate either. So I think that's a critical balance.
Yeah, I think one other thing that I'd just add to everybody here, since we're mostly focused on the sell side, it's, as Kevin mentioned, incredibly important for you to network. But also remember that all the buyer universe, all the sponsors of the PE firms and all the strategics and their corporate development teams, they're doing the same thing. They've got lists of people they're interested and they want to network with you. So it's not some cold outreach that it's going to be unwelcomed.
Yeah.
They want to have these same conversations because they want to do the dance too.
Absolutely.
Yeah, and Kevin, you said something that was really important about just being a thought leader or investing in thought leadership, right? I think we don't do that enough because as founders, we're so busy and like day to day, and we're like doing this fundraising at the same time, launching growth. But I think just building thought leadership, and you have Substack, you have LinkedIn, you have so many platforms, events where you can just go show up, and once you have your target list, even if it's a big one, you can just go after those targets at events as well. But I think just showing thought leadership across the board, wherever you are in your space, is so critical, which we don't really pay attention to or give a lot of thought to, and I'm glad you spoke about it. I think everybody should be investing in becoming a thought leader, along with growth of the company, which is super critical as well. But visibility is important.
Sure.
So John, I'm going to ask you a bit about valuations, our favorite topic. Valuations in M&A, of course, are more critical than ever today. So what are the most common valuation methodologies that you are using in M&A transactions for early stage companies? And how do founders build a compelling case for their own company's valuation?
Yeah, I mean, JP outlined a lot of the items earlier on in the overview in terms of whether it's revenue multiples or if you're EBITDA positive and EBITDA multiple. Those are the benchmarks. Those are what everybody kind of has to give you relative scale evaluation for your industry and sub-industry. So they're great reference points. I think the more important element is back to what some of the other panelists, like Kevin and team, have said. What is your value proposition? What is it that really drives the value of your business? There's a lot of companies that are pre-revenue or the revenue is so insignificant, but the technology value is significant. And so there's no multiple, there's no metric for that. It's a market perspective. And then there's later stage businesses, which no, we're more mature. We found product market fit. We're growing. We just need more capital to continue to grow. And then the valuation metrics become much more relevant. So it's about sort of knowing where you are. In terms of what to do, know what your value proposition is and have a very clear way to articulate that and give data behind it, because you might be able to have the first or second conversation with a slide or no slides around here's what we're doing. But the second or third is, okay, show me the data, give me the customer cube behind it, show me what's driving this. And if you're not ready to have that information relevant and it doesn't tell the same story, that probably wasn't useful.
Yeah, agreed. So I'm going to, on a similar vein, I'm going to talk about, just leverage, Catherine. So how do you negotiate leverage? So given that the larger acquirers often have way more resources and experience, how can founders maximize their own negotiating leverage during this M&A process, especially when dealing with more established entities? And what strategies have you seen work where founders can protect their own interests?
Yeah, it's such a good question. And this is, often the space that I play in is working with sell-side founders who are being acquired by much larger tech institutions. And it is such a tricky thing to do because an acquisition is so exciting. It's such a big process. It's incredibly time consuming. It's disruptive, as has been said many times on this panel, which cannot be said enough. And, I think one of the core things that a founder can do in a process to maintain that leverage and to maintain their own stance in the process to give the appearance of leverage too, which is also not to be underestimated, is to remember that you don't have to do the deal. Now, I will footnote that and say that if this is a distressed company, totally different topic of conversation and totally different way of thinking about leverage and how you navigate that transaction. But if this is not a distressed situation and this is a process, the company's considering an acquisition, always, always, always keeping in mind, you're not choosing between this buyer and this buyer. You're choosing between this buyer, not doing the deal at all, and maybe other, potential strategic options as well, including a fundraiser or something similar. And always having that on the table and coming back to that, what is our standalone plan, is key to maintaining leverage, right? Because you're able to think about all aspects of the deal with that constant mental check of, I don't have to do this. And that gives you inherently the leverage and the ability to stand up for whatever position you need to take. The other piece of this, and this comes into play with every transaction, distressed, very positive, whatever the deal is thinking about your end goals and having those conversations. Like, what is the genesis for this transaction? What is the ultimate goal for your board, your investors, your management team? And obviously I can get into the legal of it all and fiduciary duties. And ultimately you have to be maximizing value for your shareholders. And that is at the crux of it, right? But there are so many other pieces to a transaction that go into evaluating a deal beyond just valuation and the value going to your common shareholders. And as you think about why are we doing this deal? What is the point? What are we looking to get out of it? Is it simply high dollar? Probably not. That's probably not the only thing. And so what is it that is key to your side for getting this deal done? And always coming back to those points and having a very clear message, a very clear position that you can constantly communicate to the buyer. Because if you're just fighting, tooth and nail for every point and trying to win as many points as possible, you end up losing overall, because you lose credibility, you lose your story, you lose your message, and you don't win on the points that matter the most to you, your board, and your stockholders. And so kind of having that consistent story that you're able to tell, so that the other side, when they go back to their, separate conversations, they can say, we know they're not going to agree to this because they are doing this deal for XYZ. And they can understand your position and know where they have no chance of winning. Being able to have those states of mind, which is easier said than done, is key to maintaining leverage.
I could not agree more, right? I love that you emphasized on the why, because I truly do agree that once you figure out the why, which is not easy to do, but once you do figure out the why, the who and when will follow right after, right? And also I like what you said, where, know your worth, right? You need to know your worth, just like everything in life. But having said that, you also need to balance that. I've been part of at least two companies where we've had amazing offers on the table, and the founders have walked away because they thought they were worth billions of dollars when that was not the case. So, definitely know your worth, but obviously also keeping an eye on reality. And that's really where, Kevin, I'm going to ask you to talk a little bit about working with investment bankers, right? Like in terms of resources or experts. So engaging an investment bank, it can significantly change and impact the outcome of an M&A deal. So when is the right time for founders to engage an investment bank for an M&A process? And of course, what are the key considerations while selecting one? How do you even pick an investment bank or an advisor that'll help you with M&A?
Yeah, it's a great question. And again, I don't think this is certainly a one size fits all, but I think what we're saying, and I think what should be clear is that it's never really, too early to start vetting, right, potential partners. So certainly investment banks are going to be one, and just shout out for John and Catherine too. But I think obviously like the tax and legal fund are just as equally important, if not more. So engaging them as early as possible is probably just as critical. I will say that. And we recommend the same thing to earlier stage companies. Having those advisors in your corner is really critical. But look, we went through this as well. We as a company ourselves are private now, and we raised our Series B last year, and we hired a bank to help us. And part of that is because, right, you don't have the bandwidth to do this all yourself, right? And to market your company out. And so you want to leverage an expert, right? So at the end of the day, you probably are going to need a bank to be able to go out and sell this. So, I think, look, as soon as any founder starts a business, right, and opens this business, I think in the back of their head, they're kind of planning their exit strategy in some way, right? And so you should be having, right, periodic discussions with investment bankers to kind of just stay up to beat on current market trends and company valuation and all those kinds of things. Again, I think those are you're not going to have to spend a lot of money, right? Frankly, they're going to want to foster those relationships with you, in the hopes that they'll be able to work with you at a later point in time. But yeah, I think those are some of the critical things. And then, like, when does the acquisition, you want to make it clear, become like a key part of your growth strategy, right? So again, maybe you're starting to engage with an investment banker early, but like figuring out, like, when does it really start to hunker down, and where am I really going to need your services to go out and market this and help us, to accelerate our financial performance, and go out and expand to the market and sell us. So certainly, I think, again, early is certainly better. Having some of those discussions early on, I think, is great. And so choosing a bank, right? You want to understand, like, who's a bank, obviously, with a good, there's a lot out there. It has a really good track record, but also has worked on, let's say, similar size and scope deals of what you're looking at. And maybe, again, even similar verticals. So, right, if you're a fintech or something like that, like, do they have expertise in that space? You certainly want to allow yourselves on that as well. And again, it's very easy to understand who has a good track record of successfully helping companies exit. And with that, right, it's going to come, they have that sector now, they're going to have the industry knowledge, right? So if you understand they've worked on M&A transactions for fintech or healthcare companies or AI, they're going to have that specific industry knowledge that you're going to need. And they're going to have advisors, frankly, that are going to be able to provide really valuable insights into market trends that no one else will be able to provide. So yeah, I think those are some of the critical things. And again, all of this is going to help. I think that you can look at, right, we talked about the network, I've said it over and over again, but they're an extension of that, but they're just going to, like, they're going to really amplify that networking effect for you, right? It's going to really, like, it's going to turn, you kind of have to inject your networking with, like, some steroids. And that's what investment banks, frankly, is going to do for you, right? So those are the little things. And I think there's the soft skills overall. You're going to probably talk to a few different banks, and frankly, you're just going to find someone that has the right kind of communication style and cultural fit with you and your management team. And that's who you're going to probably align yourself with. So yeah, those are some of the things I think that are important, kind of, thinking through when thinking of engaging with investment banks.
I love it. And I heard this, a while back, people sell to people, right? So don't pick a douchebag is what I heard last time, like, when we had this panel years ago, and I could not agree more with you. So important to have somebody with the industry knowledge, but also, like you said, good soft skills as well. I think it's so critical. We only have a little bit of time left. So I really wanted to also ask the same question really quickly, Catherine, to you and John as well, just in terms of, any thoughts on mentor resources, banking, partners there.
Yeah, I would say leverage your network in terms of advisors. The three of us here, others outside in the market, we're experts. This is what we do day in and day out every day. Leverage your advisors. Talk to us early, talk to us throughout the process. That's really what it is. This is more networking. If you start coming to people after you've had initial conversations and outreach, you're too late. You're always going to be behind. So the best way to control the process, to have successful outcomes, is to plan ahead.
Yeah. Catherine, anything else you want to add?
Yeah, the only other thing I would add is don't be afraid to have conversations. If you already have relationships with certain people, if you already have a legal counsel that you've been working with for a long time, don't be afraid to have conversations with new folks. Everybody has different expertise. There's people's roles in the life cycle of your company change. You're not going to want the same attorney who has done all of your, the formation of your company to be the one that does your exit. Maybe it could be at the same firm, but it's unlikely to be the same person. And have those conversations, understand who your contact should be, understand who they would recommend, who they've worked with on other deals. If you, find an investment bank that you love, ask them what counsels they like. If you have a counsel that you like, ask them what banks they've worked with on similar type deals, right? Everybody knows everyone. And so, you can get those referrals. Like John said, use your network.
Love it. I think that's our big takeaway. Prep early, use your network, and yeah, there's just amazing resources out there. Reach out and make use of them. Where I really want to leave some time for Q&A from our amazing attendees. We've already started getting so many questions I see in the Q&A section. So I'm going to ask Colin if he can come and help with fielding the Q&A questions, which I'm already seeing is full.
Amazing. Well, thank you, Donna, Catherine, John, and Kevin. We call this a boot camp for a reason. You covered a lot, but we got some great questions coming in. So I'm just going to roll through them. So for Catherine, if my company's acquired, how do I survive the acquisition if I want to be engaged on an ongoing basis as a board member? And I know this depends based on the contract and all the terms, but any advice there if somebody wants to make sure that they stay engaged in the company's trajectory?
Yeah, sure. Start those conversations early. If you want to stay on, assuming you're a founder, if you want to stay on with the company going forward, those conversations should be had before a term sheet is served up, or at a minimum in your first comments to that term sheet. You should set expectations around what the treatment of the team should be. That includes the founder, but also additional key employees and all employees at that stage. If there's a founder that's wanting to stay on as a board member, having those conversations, that is critical to have a conversation early on the board makeup of the post-closing combined company.
Amazing. That's great advice. I think all of you have exposure to both the buy and the sell side. We're talking about the sell side here, but somebody's asking here, what about the buyer's expectations, particularly in the tech sector? Do they rely on complex complex valuation models, or is a 5x multiple still considered a benchmark for deals? John, maybe I'll kick that one over to you, and then if anyone has anything to add.
Yeah, and if you saw JP's chart in the very beginning, I don't think 5x has been a multiple, is currently where things are either from a revenue or an EBITDA perspective. But buyers are going to look to multiples. They're going to have their own expectations. Everybody's going to, we talk about multiples because it's a good benchmark, but every company's negotiated individually, uniquely. And every buyer is going to come with their own perspective on what drives their value. They're going to build their own models. They're going to know how much they can pay. And they'll use some reference points there. But I wouldn't worry so much about buyers' expectations, worry about your expectations and finding the right buyer.
Awesome. Thanks, John. Let's see. Donna, you've been through multiple acquisitions and one more recently. Do you have any good processes and/or sources to keep track of the activity of your prospective acquirers?
Yeah, so I think again depends on the size of your company, but I've done, we've started with simply like a spreadsheet where we just come up with a target list. But I think what I would really recommend is coming up with again, going back to the why, right? Starting with the why. And once you get the why down, then you start going through the list of who are the target potential acquirers that would resonate with your why. What is the value add that you're adding? So I would be very thoughtful about, even if it's just an Excel spreadsheet, just really having columns for each and everything that you're thinking through. And then tracking this on a weekly basis. Have things changed? Has our growth stories changed? Has our acquirer changed? So whatever tool you use, even if it's as simple as a spreadsheet, start with your why, come up with the complete breakdown of what the value add is, who it is that you're selling to, and then just keep tracking. I think that's like the main thing. It doesn't matter what tools you use for that at the end of the day.
Great advice. Kevin, I'm going to pick on you on this one. At Nasdaq Private Market, you deal with a lot of founder-driven liquidity and ownership. So this question right here is, what are your thoughts on when a founder buys back their company? What advice would you provide to avoid seller's remorse?
Yeah, it's interesting. I mean, so right in the world that we live in, what we see in the construct of secondaries, there are the two main constructs are a company, when it wants to provide liquidity to their shareholders, may buy back shares, right, from existing shareholders, or they're going to, company's going to look to work with maybe existing cap table holders or bring in new investors to provide some liquidity for those shareholders. I think we've seen a shift much more towards third-party driven transactions versus the repurchases, if you will, right? Where the companies are actually buying back. Frankly, though, for years, it was very close, meaning like close to 50-50 overall in terms of the market, what we saw from a buyback versus third-party driven tender offers, if you will. I think one of the things that, I think there's a few different things to consider, right? A lot of times these buybacks are driven by founders or others who want to just really keep a really tight cap table. And so, right, they're thinking, hey, if we have an opportunity to buy back more shares and we don't need to bring on new investors, let's do it. You control the price that way too, right? You don't have to working with a third party to negotiate the price for those shares and the sale of those shares. So again, it's more about control sometimes for those buybacks. I will say what we see in the market though sometimes from the shareholder perspective, who's actually getting the opportunity to sell. Sometimes I think this is a misconception when they see that the company's saying we're going to buy back shares from you versus a third party, and they see what the price is. Sometimes the individual is like, oh, well, is this a good deal? Like the company's just saying this is the price, versus when they see third party investors who might be these big strategic, investors, crossovers, whomever they are, and they're putting a value on the equity. They look at that as, being a little bit more valid in terms of the price. And so that helps drive, I think, participation in the market overall in terms of when people are looking to sell.
Great. JP, welcome back. There's a question here that I think you might be able to dig into. What are some of the best tools that you can point to for determining an up-to-date and fair market benchmark company valuation?
I get that question all the time from I'm doing 10 million in ARR, what's my valuation? Unfortunately, there's so much that goes into valuation that just taking a revenue times a multiple or an EBITDA times a multiple really just doesn't do it justice. There was a question earlier about is the 5x multiple, is that, kind of the standard benchmark? Really, there are no standard benchmarks. Number one, and this is, you have to run a competitive process. Nobody wants to pay more than they have to. So if you wanted to get it from 5x to 6x to 7x to whatever the X may be, you need to have competition, right? So you need to have 3, 4, 5 buyers who are buyers or investors falling all over themselves. And then when you talk about valuation, I use this example a lot. You have two companies doing 25 million in revenue. If one of them has a TAM of 30 million, that's not very interesting from a buyer or investor perspective because they already have 90-ish% of the market. But if you have another company doing 25 million in revenue and the TAM is 2.5 billion, they've barely scratched the surface, and there's a huge opportunity for growth there. So when I get that question, I think about valuation from the perspective of, obviously you have to have good financial metrics, right? What's your growth rate? What's your scale of the business? A company doing 2 million in revenue versus a company doing 50 million in revenue, two very different valuations. What is your operating margin? Are you truly a software company or are you a tech-enabled services company? Are you profitable? Are you not profitable? What's your TAM? What's your management team like? What's your secret sauce? What's your competitive dynamics? All these different things, what somebody, Donna mentioned earlier, what's your value proposition, right? All these things go into what your company is worth. So I'm not punting on the question, but it's just, you can't answer that question in a vacuum.
Yeah, agreed. It depends, but some great advice there.
That's why I hire an investment banker.
Yes. Catherine, question for you. How much is intellectual property a driving factor in acquisitions? How are pre-sale, pre-product, IP-based M&As valued?
So it would depend very much on the company and the industry, how important IP is to that transaction. But I would say in most of the transactions that we deal with here at Wilson, it's the key point, the primary point that gets both diligenced and considered in evaluation. And so understanding why, this goes back to the whys of the deal. Why does the buyer want the company, right? Like that's the key driver in both valuation, but also in risk. So that's going to be the focus of the diligence process as well.
Totally. Donna, I keep picking on you for the specifics on M&A stuff, but you're a pro here. Let's see. Do you have any recs for a reliable data room?
Yes, and I think I will send it. I mean, I can send it via, I don't know how we follow up, but we can do that as well. But yeah, I mean, do you want me to just name a few or?
Oh, I mean, you used them, so they're just
Yeah.
asking.
So I mean, I've used, there's a bunch of virtual data rooms that are great for like, sensitive M&A transactions. They're reliable, secure. I'm just going to rattle names. I don't know if that's going to help people, but the ones that I've used in the past are DataSite. It's really great for handling complex, large-scale M&A deals. I've also used Firmax. I've also used Deal Room, which is, I think, a very popular one because it really streamlines the whole M&A process. But I think more, so I mean, there's a whole bunch of them. But I think for me, I'm going to focus a bit on what are the key criteria, like what should you look for when you're choosing a virtual data room? Really look for obviously security, right? Encryption, two-factor authentication, granular access for controls, because you're going to have different people having different levels of control, because you want to make sure you get people to see what you want them to see. And then also, of course, customer support, because you're going to need somebody who's going to be able to help you if you're doing this for the first time. Ease of use is important. And I think obviously pricing, especially if you're an early stage startup, make sure you're also, because it can get expensive really fast. But yeah, I think that's why Deal Room is a good option. Secure Docs is another good option. But I'm happy to compile a list with all the criteria as well, because I
Great.
have a lot of information.
Yeah, no, yeah, I think it's great advice.
Colin, really quick on that, if I can, just to add on to Donna's point. As she mentioned, there's a bunch of them and they're all great. From a sell side perspective, one of the things you want to keep in mind, and they all have this, but what are the metrics of the potential buyers and investors who are using it? Because that's important. You want to see who's in the data room, what they're looking at, how often they're there, as opposed to oftentimes there'll be people who want access to the data room and there's just no activity. That'll give you a good insight as to whether they're serious or not.
It's a great
Mhm.
point, actually. That's a really good point.
Amazing. Well, we're almost at time for our key takeaways, but we got a couple other questions, so we're gonna do lightning round. Um, Kevin, can you talk a little bit about the usual makeup of a corporate M&A team other than hitting up John, Catherine, and everyone on this call, and including yourself?
Yeah, look, I mean, they can speak to this, but I mean, look, there's going to be a lot of, I think it's a lot of what we've talked about. I mean, it's going to be probably internally, you're going to probably have a few folks that are focused on, right, the goals and the strategy. And that could just be you and maybe your co-founder, maybe your, VP of finance. If you get to a point where you have a CFO and others, obviously incorporating a few more folks, it's all going to obviously depend on size and scale. But then it goes back to leveraging your advisors. So we've talked about all of them, and that this includes. I also do think that these tools like these data rooms, I think are very important. But certainly the legal, the tax are the critical ones, and the investment bankers, like having that really core to surround your team is really vital. And I think there's going to be some stuff you're going to be able to maybe handle internally, and if you have a really good finance team, you're able to leverage and others in a really good legal team you're able to leverage. You may think, hey, we can get away with doing this ourselves for a little while. But the truth of the matter is, you really can't. And so it's not about I don't think it's not about ego. Like everyone's really smart, but I think at the end of the day, you still have a day-to-day job you need to focus on. And there's a lot of different functions that you need to really help drive and support in your company. And so that's why I think it's critical to have those other trusted advisors. But feel free, anyone else can add.
Anything else? John, you look like you moved a little bit, but we can move on to the next question.
We can go on. I think Kevin
Okay,
said it
great.
well.
Um, let's see. Um, this is a general question, so feel free for anybody to take it. How deep should we allow a buyer to dig into our core tech during the due diligence process?
Yeah, maybe I'll take that one real quick. If you're a tech company, tech diligence is going to be one of the key things that any buyer's looking at. So you should expect them to dig in really deep into your core technology platform. They may ask a third party to do a code review around sort of open source and some other areas. but they're going to dig into your software development lifecycle. They're going to dig into the product, the scalability, because again, they're probably asking about how do we grow this business and how do we integrate this business. And so understanding that core technology is going to be really important. That's going to be a key gating item for them.
Amazing. Well, we're out of time for questions, but I do have one last question for this amazing group of folks. And I think Donna pretty much took care of the key takeaway portion of this. So I'm going to pivot. Are there any books or research places that you like to go to learn about the current state of M&A or just this M&A strategy in general? Catherine?
Specific resources aren't coming to mind at the moment, but looking at all kinds of M&A industry data, like the ones that we saw this morning from KPMG and many of the accounting firms, banks, law firms will produce like quarterly reports, and finding a few that seem to speak best to your industry and continuing to follow those on a regular basis will help keep you apprised of what's going on in the market and what you're seeing in your particular industry focus.
Awesome. John?
Yeah, I think that's a great point. Your advisors, we're all putting out content for all of our sub-industries and industries about what's happening in the market. So leverage that. But incremental, if you want to spend a little bit more time every day, there's a handful of newsletters. The New York Times Deal Book, Axios has Pro Rata, Fortune has another one. Like they just tell you what's happening, who's transacting what. It's a 3-minute read every morning for each one of those. It just tells you who's transacting. I think that's nice to understand who's moving in the market.
Donna?
Yeah, I'm going to recommend a book. I know it's not popular opinion these days, but I love the book, The Art of M&A. It's like a long title, Merger, Acquisition, and Buyout Guide. It's basically, I love it because it's a classic guide that offers very practical, very accessible overview for people who are not very familiar with the M&A process or also not very deep into it. And it really covers like all different stages of a deal. I think it's really a great resource for all aspects of M&A.
Kevin?
Yeah, maybe I'll just add another. I think it's the only book maybe that was M&A related, but I thought was really cool. I think it's M&A Titans, which is a really cool kind of historical book about the people who kind of helped shape the creation of the what in effect is the Wall Street's merger industry, for lack of a better term. So kind of talking about those folks and the personalities that were prevalent through the 70s and 80s, I think is a really cool book.
JP, round us out.
Nothing in particular. I would just say rely on your advisors, whether it's bankers, lawyers, accountants. We are experts in our field. I can't go build a technology company or start a software company, but I help sell them, and that's from a founder owner perspective, from a board perspective. You need to focus on running your company. There's nothing worse in an M&A process than when you give projections for the next 1, 2, 3, 4 quarters and you miss those numbers, your process is over. So if you take your eye off the ball and you want to learn the M&A part or the legal part or whatever it may be, and you're not selling or servicing your customers, hang up the cleats because the process is over.
Amazing. Well, we're at time. Thank you all so much for sharing your insights into M&A strategy. Donna, Catherine, John, Kevin, JP, really appreciate you. And looking forward to seeing if these strategies will pay off in the future for our attendees. Before we take our break, we're going to be launching a quick poll in case you want to follow up with John, Catherine, Kevin, or JP. So I'm going to launch that poll. But thank you again, Donna, Catherine, John, Kevin, and JP. What a great insight sharing. Thank you so much.
Thank you all.
Thanks, everyone.
Thanks.
Ready. So I'm going to launch that poll. And we're going to take a quick break. We're going to be back in 5 minutes to talk about our next panel, Growth Through Acquisition. That's our buy-side overview and insights panel. So we're going to return in 5, and we'll see you then. Thanks, everyone. All right, all right. Welcome back. Before we begin our next panel, I'm going to launch a quick poll to just get a gauge on who we have joining us for this session. So, this next poll is how many acquisitions are you planning in the next few months? To our panelists, Mark, Francois, and Roberta, we polled everyone earlier, and it was a clean 50-50 split on what side of acquisition people are looking to learn about today. So, interested in these poll results? I'm going to let this run for just another moment. I'm going to end that poll and share those results. Looks like a majority of you are just thinking about it, and many of you are thinking in 1 to 3. So thank you for participating in that poll. So on to our topic for this afternoon, growth through acquisition, the buy-side overview and insights panel. So please join me in giving a warm welcome to our guests. Our moderator is Roberta Burrows. She's a board member at the Nasdaq Entrepreneurial Center, and she's also leads strategic initiatives in AI and cybersecurity. We have Mark Holloway, who's a partner at Wilson Sonsini, and we have Francois Chadwick, who's a partner at KPMG. Team, looking forward to learning more on this one. Roberta, over to you.
Thank you, Colin. Hello, everyone, and welcome to today's conversation. We are spending time today talking about growth during M&A, and I am very pleased to have Mark Holloway here again with me, Wilson Sonsini, and Francois Chadwick from KPMG. Welcome to you both.
Thanks, Roberta.
Right, all right. Before we jump in, because I'm pretty good at just jumping right in, did you all want to say any words to our audience today? This is the last panel of the day, so definitely want to give you the floor, Francois.
Yeah, well, thanks for everyone. Hopefully they've all had a great day, and we'll make sure that this last hour is as lively as possible in case the coffee's sort of wearing out a little bit. But Francois Chadwick, I'm a partner in the San Francisco office of KPMG. I have national and global roles within KPMG. This is actually my third time back at the firm. For the last 10 years or so, I was on the other side. I was an operator. I joined a small company way back in 2010, 2011 called Uber when there were 25 people, helped scale the company, helped take it public. And then I was CFO of 2 other companies that I took public as well. And obviously, especially at the time whilst I was at Uber, we did many different types of M&A deals of all sizes, transactions, and locations. So really looking forward to this. Roberta, Mark, over to you, my friend.
Yeah, thank you, Francois. So Mark Holloway, I'm an M&A partner in the Washington, D.C. office of Wilson Sonsini. My practice is about 50% domestic U.S. work and then cross-border work involving the UK, Europe, and the Middle East. Been here for about 13 years. I've actually done a few deals opposite Uber, so Francois and I may have unknowingly been on opposite sides of a transaction, and looking forward to discussing the various topics we've got teed up for today.
Awesome, so great. All right, let's jump in, guys. Francois, going back to you. What are some of the trends you're seeing on the buy side right now? Particularly, with changing market conditions, obviously there's been a lot of conversation around interest rates. Are we going to have an economic downturn? But also too, we cannot go without having a conversation on this particular panel about AI and how that's affecting the buy side. So what do you think?
First, I'm just trying to wonder if there's can we get through a day sometime in the next month where we just don't say the initials AI? It may be possible. I don't know. It's probably impossible.
I don't think
so. Roberta, it's a great question, and I think on the macro environment side, the interest rates are somewhat coming down, and so people have started to look at more. I think just generally, there's been a bit of a slowdown in the M&A activity, and the empirical evidence has shown that over the last year or so. So there's definitely some sort of pent-up. I don't want to use the word frustration, but there's definitely some pent-up demand there for folks to think about what else they could be doing as they're looking on the buy side of things. The interest rates are helping. Some of the things that were the uncertainties in last year, especially with all the elections, a lot of that is now behind us. However, I think there's a certain amount of new uncertainty that's still sitting out there that's coming into play. post the elections across the world, not just here in the States, across the world as well. Plus, together, they will still have some of these geopolitical uncertainties as well. But I do think, and Mark, you should jump in as well. But I do think there's definitely a lot of like asks around what is out there, what should we be thinking about, and I do think, and we'll unpack this a little bit more as we go through the hour, Roberta. But I do think there's definitely a space in the AI world right now where it was similar to it's almost like the SaaS world, where some of the larger companies are now looking at some of these smaller AI type companies and really thinking, hey, what are they doing? How could we roll them up into what we are doing? Are they part of a product? Are they part of a feature? Is it part of our platform? Before their valuations maybe get so far that they can't, for want of a better term, afford them. So I think we're going to see a lot of that happening. There's been one or two actually that was announced this week in the AI space. I think it was MongoDB that announced something yesterday or the day before. So I think we're going to see more of that. And I think the interest rates and some of the macro environments are going to help. But I still think there's a little uncertainty.
Okay. All right. Mark, obviously you can fold some of that same question into the one that I'm going to ask you too, because it is relevant in terms of just how is the current regulatory environment, how that's been affected and impacted M&A activity, particularly around if we add on to some of the things Francois was just talking about, antitrust, data privacy, even AI policy, all of those things. Could you speak to that a little bit?
Yeah, absolutely. There's so much to talk about here, but I'll try to keep it very concise. The previous administration, definitely parts of it had reputation for being sort of very heavy on the regulatory pedal. The FTC in particular, was pretty transparent about saying, we'd like some deals to just die in the boardroom, knowing that we are going to really scrutinize these and maybe you just don't do the deal. The FTC was a big part of it, but it played out in a number of different ways. And part of the hope had been that, or the projections had been with the change in administration, that there's going to be a big regulatory change. We don't really know yet. So I think a lot of people are in the crystal ball phase of what's going to happen. There's things that people have said. There's been some early moves. Taking the crystal ball approach, our expectation is that on the antitrust front, that is going to be generally more friendly to deals. But as with all of this, it's industry specific, right? I think there's still, this administration still has some deep skepticism of big tech, especially if they're involved in a way that could be doing any sort of censorship. So I think you'll still see some scrutiny there. There's a new filing regime that just came into place on the antitrust front, which is going to make some filings a lot more burdensome. Part of the stated goal there is to produce a lot more documents early, hopefully to clear some deals that don't require any scrutiny, and allow the regulators to focus on the ones that do require some scrutiny. On the privacy front, we expect it's sort of an interesting, going back to the AI piece, it's interesting. Our expectation is that the SEC is not going to be chasing sort of AI regulation, especially as it relates to fintech. And so I think that'll be positive for the M&A front. On the other hand, we do expect to see states sort of step up and start to regulate AI. So we're not quite sure exactly what that's going to look like yet. That may be a bit of a headwind there. As far as cross-border deals, the last few years have seen a big rise in restrictions on cross-border investment. We expect that to continue. Make it a little bit easier for inbound M&A into the U.S. from allied countries. But there are some new regulations that have just come out that are going to make it tougher to do outbound M&A where there's any kind of China connection. So that's a kind of a headwind, at least with respect to Chinese related deals. We're expecting on the crypto front that to be a pretty big change in the sense that there's going to hopefully be more regulatory certainty around that it's going to make that a more attractive business sector, with additional regulatory certainty. And we've already seen some deals in that space. I think those are those are the big ones. I guess the other thing that we may see the SEC take some moves to make it easier to become a public company, make it easier to be a public company from a disclosure burden perspective. And of course, more public M&A or, more public companies means, more takeover targets, more companies with public company stock as acquisition currency. So lots of ways in which some of these changes could, help drive better M&A in 2025, but it's early days, and so a lot of speculation at this point.
Yeah, lots going on, lots of changes. Francois, did you want to
I
add
was,
on to that?
yeah, the only thing I would add on is if taking the word you used there, Roberta, about regulatory, I think
Mm-hmm.
where I do expect we will see some sort of M&A activity is in some industries which may be regulated or have a regulated piece to them, or the regulations may be changing. So think about some of the AI rules within the EU, right? I think
Mm-hmm.
that in a way could potentially lead to some M&A deals. So, in my prior life where I was in disruptive companies where you're disrupting a certain sort of thing and then regulations come in and you've got to pivot because of the regulations, that can actually lead to either acquiring companies or doing some sort of acqui-hires where you're bringing in something because the company's had to move slightly from its prior position to something else. And I think we're going to see some of that. For example, there's going a lot of the large language model, frontier foundational companies use a lot of data, right? And there's a lot of legal lawsuits going on. Where's that data coming from? So I think what you might find is there's going to be deals where those companies are going out and buying or acquiring or somehow partnering, but an acquisition is a potential where they're going to go and buy the company that has the data. And then that's going to become part of them so that they have that ability to continue doing their business model. So that's a space where I say, like, we're going to keep an eye on.
That's pretty insightful. What were you going to say, Mark?
I was just going to say that that's a great point. I mean, one of the things on the regulatory front is, data scraping from websites has obviously been a thing for some time now. But now that with the rise of AI and the need for these models to have lots of data fed into them, there's a marketplace for the scraped data that didn't exist before. And so now there's a much more of a focus on, hey, wait a minute, what are the consequences for taking data off of websites that might not be compliant with the terms of the site. And so not a new issue, but it's getting new focus because that data is so much more valuable because there's so many potential buyers for it.
Yep, that is definitely an insightful point and a different way of thinking about it. I think that people talk about that, but just to hear that from you, because you all are actually doing the work and that's the reality on the ground. So that's a huge insight, at least from my perspective, and I think from our audiences too. Kind of switching a little bit, Mark, from like the buyer's perspective, how are acquirers like approaching valuation? What are some of the key financial metrics right now in terms of deal terms that they're focusing on? For example, like how does this differ from how a seller might view a valuation, or from a legal perspective, from your side, what are some of the most common mistakes that buyers may make during M&A, et cetera? Can you talk about a little bit?
Yeah,
Talk
sure.
about.
Started with the valuation piece, and this is one where definitely Francois should weigh in, since lots of jokes about lawyers and their ability to do math. The KPMG guys, I think, are a little stronger on that front. When we think about valuation, for buyers, it depends a little bit. Are they public or private? If they're public, they have a story out there, right? They've got a business model that maybe it generates cash, maybe it consumes a lot of cash, and they're not cash flow positive. When they're doing acquisitions, the metrics that they're putting out to the world about how you should think about our stock, how you should value our stock, are going to matter for any kind of serious acquisition around how does this change the story? Does it add to it? Does it address some perceived weaknesses? And so that's going to have some influence on, do we care about cash flow? Do we care about revenue? What are we going for here? On the private side, you've got some more flexibility. You don't have that sort of public story that you're tied up in. And so you've got a little bit easier path there. I find with the private deals, the financial piece is part of it. It's a lot more about the bigger picture of what does this mean for the company? Does it allow them to do something they couldn't do before? Are they picking up IP or people or products that didn't that wasn't part of their uh, package before, and so they're adding that to the piece. For sellers, if they're patient, they could use the exact same methodologies, right? They could do a discounted cash flow analysis. They could look at EBITDA, they could look at revenue, they could look at comparable deals and multiples. They often, because they're usually dependent on, capital continuing to come in the door, if that gets threatened or their growth really plateaus where it's clear that this may not really work as a standalone business, then it becomes less, the financial metrics matter, but they may not have the patience to find somebody that's willing to look at them on that basis. And they start to think about, okay, how much cash do I have left? How long have my investors been in here? How long, how many years are left on their fund life? What's the return on those investors' capital going to be? How are they going to feel about that? Is there enough likely proceeds to kind of get through the waterfall so that all the investors get their money back, the common gets their money? And so for them, it can be a different set of circumstances about, is this a good enough deal that we can get it done? Are my investors excited enough about it to engage? Does the management team and the option holders get anything out of it? So it's a bit of a different perspective if they don't have the ability to kind of wait it out. I think, why don't I answer the next, because you asked me about sort of common mistakes buyers makes as well. I'll jump in there, and then I'd love to get Francois's, point of view on some of the things I just talked about.
For sure.
Buyer mistakes. I think there are some, it's not so much about what does an individual buyer do where they said the wrong thing or did the wrong thing and everything falls apart. It's more about does the acquisition ultimately work out? Do they win the deal if it's a competitive process? One thing that if you're not in the market a lot, understand really calibrating your risk tolerance is hard. And spending some time doing that, I think, would benefit most buyers to say, okay, what if I'm not sure how to evaluate this risk, right? AI is a great example where right now we're seeing people serve up, 3-4 pages worth of AI related reps that may have nothing to do with the business. And the buyer hasn't really reconciled with what they think the risks of AI are. And they see that AI is being used a lot in the business, but they haven't thought about, well, okay, the salespeople are using ChatGPT to write, cold emails. That's not a high risk thing for the most part. If it's using AI and making hiring decisions that might be subject to kind of anti-discrimination rules and regulations, that's a higher risk area. But people are still working on, are they able to really differentiate between those two scenarios? I think some of the other issues that you run into, you look at any kind of studies on M&A, it'll tell you that a lot of deals are not as successful as people would like them to be, or they're not successful at all. And I think a lot of that is, are people, do they do a good job with integration? Are they self-aware enough to say, here's what our company culture looks like. This target that we're acquiring might have a different culture. Can we really integrate it? If we do integrate it, can they adjust, or is that going to kind of break it? Do we need to leave it alone because it's very different and our cultures are different and they just need to sort of be walled off from each other so that we don't sort of destroy the value we just acquired? And we'll talk a little bit about integration more later, I think, but it's one thing that it's not easy. And I think it's one that folks probably don't plan enough for.
Good point, Francois.
Yeah, I think let me start with the sort of the joke. And Mark, yeah, this sits with some of my colleagues. I could take 5 valuation specialists and ask them to value one thing, and we'll come up with 8 different results somehow on the value, right? And I think especially, sort of putting aside the sort of the public side of things, when you're especially thinking about valuation in the private side, echo everything Mark has said. And on top of that, there's also a lot of emotion that goes into valuation, right? Both on the buyer and the seller side as well, because they may have had visions as to where the company was going to go. This is the sellers. They have a vision on where it's going to go. And then they realize that, they're not going to go public and there's this opportunity here to be purchased. And that starts to factor into how they think about it, especially if it's a founder-led company where is their place in life once they've actually been bought by this other company. And so that those things I've actually seen in real life that impact the price that it ultimately gets paid. And so that's something that you just gotta think about as you're going in. It's an emotional deal as well as a financial fiscal deal. And some of the things where I've seen these things go wrong is where too much emotion is brought into it. And there's a vision and whatever else as to where they thought they were going to be, and then they up the price, and that just goes beyond what the buyer was actually looking for, and so the deal just withers on the vine. Um, the other thing as well that we're seeing a lot of still is, whether you wish to call it the fallout or whatever, but obviously we had the peak of the sort of the IPOs in 2021, where a lot of companies went public through a SPAC, and then a number of them didn't. We all know that we can see the empirical evidence on which ones are successful, which ones didn't. But we also saw a lot of companies coming into 2022 and 2023 where growth at all costs disappeared. Suddenly, it was a big focus on cash preservation, and the companies that have been successful got there, whatever you wish. It was bridge debt, bridge financing, bridge equity to get them through to about now. And the valuations aren't the same as they were back in 2021. But I think there's a dawning realization now with those companies that they're not going to get back to those valuations. Those valuations in 2021 that was a spike, that was an anomaly, that was a very frothy time. And so now, looking at the valuation of the company now and looking at what they've got on their balance sheet and where their growth could be, we are going to see this M&A deal back to the macro environment, back to where things sit right now. I think we're going to see more M&A activity because there's going to be focus from the investors in these companies to sort of say, what's your next step? If you're not going to go through an IPO and we're not going to fund you through to an IPO, then you're on the market to be purchased. And then you've got to have that very sort of frank conversation about what your valuation is and try to match, the market of what someone would look to buy you for. So I think a lot of emotion and a lot of things that are going to fall out from that 2021 spike as we look into through the rest of 25 and into 26.
I mean, obviously, this was like a lot of information for our audience, but it's so insightful and so impactful. I mean, you all spoke about outcomes, the journey, and kind of the historical through point of what's happened. And I think that's just so informative for our audience. I'm going to talk a little bit more to you, Francois, about kind of build versus buy. That happens a lot, particularly. I think you see it maybe a lot more in private companies than you do in public. Sometimes you do, but just want to get your perspective on, what do you think is more advantageous for a company to build a capability in-house or to buy it? Particularly since we're talking about M&A, and what are some of the critical considerations that drive that decisions?
Yeah, it's a very, very good question, Roberta, and it's actually one that we face, and I'm sure Mark faces this at Wilson as well. We face this at KPMG as well. We're like, hey, should we create this thing ourselves, or do we want to go and partner with someone or license something, or acquire it, right? And I think the big thing I think a lot of companies don't put as much thought into is a lot of folks go, how much is it going to cost to build? And how long will that take? And what will the outcome of that look like compared to what you could be in the marketplace right now to actually acquire? And when we talk about acquire, let's never forget you can acquire something, you can partner with them, you can license with them. An acquisition is one vehicle to get that into your suite of things in the build versus buy. But one of the things to always bear in mind when you're thinking about this is what is it going to cost to maintain it once you've built it, right? And in some of my non-KPMG lives, what I've seen is that everyone's gung-ho to build something because it's a great project and everyone wants to be a builder and everyone wants to drive value and create something because that's just the innate thing that a lot of folks want to do, and it's fantastic. But then when it comes to the maintenance of it, right? That's where it's like, for want of a better term, it's just a little less exciting, just the maintenance. And so what I do is I'm like, what I've always asked people is like, if we're going to build something, what's it going to take to maintain it? If we're going to buy something, then we bring it in. Are we going to have the continued resources from what we buy to continue maintaining it? And then that leads Roberta to the next thing, which is, or do we want to make sure that whatever it is we leave off to the side over here and we license or we partner with them as a different alternative to what we actually want to create? And a lot of it, especially when I had my CFO hat on, a lot of that was, what's it going to cost over the long term, not just the short term build or the short term buy. Um, and so and it gets difficult because at that point, you've got to get the little crystal ball out and look into the future and put numbers around things that people become more and more uncertain about. But I do think it's a matter of, if you're fundamentally looking at it, it's a matter of what is the value it's going to drive for you today and how long is it going to take you to get that value. And if you need it today, and it's going to take you X number a year, months, or whatever to build, then maybe you've got to go and buy it. And maybe you've got to go and buy it because a competitor of yours has created something, and now you're at a specific disadvantage. And that disadvantage is going to lead to an ever engulfing sort of gap between you and your competitor. And then the other thing I want to point out again, and I'm coming back to some of my prior lives, is when you have these regulatory changes which actually have an impact on the way you as your business can deliver your services, then maybe you just don't have the luxury of building and you've just got to go and buy. And that's the only way to get yourself out of the hole because of a regulatory or a legal change.
And from that perspective, Mark, if you were one of these companies and you decide, yeah, I'm going to go buy, like, what is the due diligence focus for buyers, right? Like, what are some of the most critical areas of legal and financial due diligence that acquirers, buyers want to focus on, and why? And are there any red flags that they need to look for? And also to sellers proactively, how can they address potential concerns?
Yeah. For folks that have done the diligence process, this is going to be totally old hat. For those who have only seen parts of it, may still be really useful. I tend to think of diligence as probably two primary stages, right? Initially, the business teams are going to be looking at, does this deal make sense, right? We need some financial data. We need to build a model to figure out what we can pay for this company, and is that going to align with the seller's expectations on price? And so it's a lot of financial information. It's some business diligence, but it's a lot about the numbers. It's a lot about putting together a spreadsheet that justifies this is a good use of our cash to go buy this business at a particular price. And that's what you're going to need to get to the term sheet stage. Once you get to the term sheet LOI stage with that model, then it becomes, well, we think this all works. Now we're going to kick the tires even harder to make sure that this kind of plays out the way we thought it would. So in that first stage, you're thinking about, okay, what kind of numbers do we have? Are they good ones, right? And this is the piece that KPMG is going to do a lot of work on is, okay, do we have financial statements? Are they audited? Do they use the same accounting methodology that we do? Do we trust these numbers? Great, they made money last year. Will it happen again, or was it a one-off thing? If you don't have audited financials, is there any kind of quality of earnings report that you can look at? How much do the projections play into this, where it's going to grow a lot? Do we trust the assumptions that go into that? And then there are some, liability pieces here. How good is their tax compliance piece? Not surprisingly, lots of deals in the technology space, they don't have great sales tax compliance, and there's like liabilities in 15 different states of various, 6, 7, 8-figure numbers, where once the states realize that those people should have been paying taxes, they're going to want to collect. And so that's a big piece on the liability side. As far as legal, right? We're more often than not sort of coming in off the back end. This model's been built. We've got a general idea of what we think this company's worth on the buy side. And then it becomes a question of what's the real source of value here? Why do we want this deal? And that's going to drive our diligence. Now, some things you're going to be, there's some general things you're going to be doing, but I really like to get buyers to tell me, hey, why do you want this deal? Because I don't need to spend a million hours on, real estate and environmental if everybody works remotely and there's literally no environmental piece here, right? That shouldn't be prioritized. But if you really care about the intellectual property, then let's go step by step about how was all this stuff created? Who created it? Was it clearly assigned back to the company? Did they in-license it? Did they use third-party contractors in other countries? Did you use your standard US template agreement for, that? Well, does that work under, Hungarian law, where all your developers were based? If IP is important. A big part of what we do, of course, too, is we don't do the tax diligence, but other kinds of legal liabilities, right? Were you compliant with law? And lots of startups are not fully compliant with law. And so it's a question of, okay, not compliant, but not compliant in the normal ways. Did any big liabilities come out of that? Did you, for example, run afoul of sort of sanctions things? And I'm anti-money laundering. Sorry, I can't talk today. Foreign Corrupt Practices Act, where you've got some real potential big dollar figures or reputational issues. And then the other piece of that is like, do you have the legal authority to kind of do what you're doing? Are there any kind of government approvals, permits, all those sorts of things that can blow big holes in really the value of the company. Oh, sorry. I think the last part was what can sellers do there? Probably 5-6 years ago, I was on a panel and I had a great piece of advice, which I can't remember who it was, so I can't credit them, but I'll at least acknowledge it's not my idea. They recommended finding an Eeyore. So if you're familiar with Winnie the Pooh, Eeyores are sort of very down on his luck, sad donkey, I guess he is. Find that person in your organization that can really take the negative view on things, the kind of stuff that keeps you up at night, the existential risks to your business, the areas of compliance and things like that you've underinvested in, and get them to take on that mindset and start to think about, okay, what are the real areas there? Can we do anything about that to fix it? Can we at least come up with a cogent explanation as to why we decided this was not a good area to invest time and resources in? But do we at least we're going to get asked about it. Do we have a good answer? Even if the answer is yes, realistically, we probably should have put more time into that. Going forward, you'll probably want to wrap us into your compliance procedures, but, we don't see any big issues coming out of the fact that that's not been a big focus of ours.
I like that analogy, the Eeyore in your in your company. Francois and Mark, I'm going to kind of integrate a couple of questions together because I think that they play off of each other. Francois, when we're looking at kind of the most effective methods for identifying and screening like aqua targets, like how do companies talk about, balancing that strategic fit? You talked a little bit about that when you put your, CFO hat on, but, with financial viability and kind of the legal due diligence process early on, but then two, once you start thinking about those things, let's say you do make that buy, Mark, how crucial is it to start the integration planning before the deal closes? And what are some of the key legal and financial elements that should be addressed from that perspective? So Francois, first to you.
Yeah. And I think part of the answer as to how do companies think or should be thinking about, going out there and strategically deciding what they may wish to acquire somewhat depends on the size of the company. So I've worked at companies where, we've had our own corporate development teams and they're already out there looking around at what those things could be, and they're bringing them in and we're sitting there and we're vetting them through a process. Or I've been in other companies where we've worked with, bankers and others who are out there who are actually marketing potential deals and bringing them to us as well. I think the bottom line on these, less so about the process that you go through internally as to vet it, is the headline. If you can't succinctly explain the value that will be driven by acquiring that other company or acquiring that asset or acquiring those employees, if you can't succinctly explain that, then really should you be doing the deal? That's the way I've always said it. And it's like it could be you're doing something and it's on the, like, you know, when you're playing your game of chess, it could be an offensive move, it could be a defensive move, right? But if you can't explain why you're doing it, then it's probably not the right thing to do. And there are deals I've been in where, you know, that we ask the question and the answer is not as crisp or it's not as clear as we would like it to be. And I've had to send the people back and sort of say, you got to do more homework. You got to come back to me with more before we're going to invest even more time of other folks within the company, or you're going to go and hire Mark or my team to bring them in and do the due diligence and everything else. So I think it's a matter of strategically understanding, is it an offensive or a defensive move, and what value do you believe it's going to bring, and be able to succinctly explain that very quickly. So that's the process I've always normally gone through.
Mark, from like the integration perspective, what do you think about that early on in a deal? You know,
Sure.
some key legal elements, et cetera, that should be addressed even in the pre-close planning phase, or, you know, even in the discussion, because I feel like sometimes that is missed, to Francois's point of, if you're going to buy it, how are you going to maintain it, right?
Yeah, absolutely. I'm lucky that we have a sort of general counsel in residence program where we have folks that served as general counsels of large private companies or public companies and have come in-house to basically serve as a resource to our clients to help them think about things like this, about building a legal function, because they've seen the integration side. You know, folks will pay KPMG, they'll hire Wilson Sonsini and pay us to do a lot of diligence work up front, to structure the transaction, to negotiate the transaction. And then a lot of times there's not a third-party advisor involved in the integration piece. I'm not saying there necessarily needs to be, but you know, you big massive investment on the front end, not nearly as much on the back end. And integration's hard, right? In the success rates in deals will tell you that it's hard, or M&A would, you know, more M&A deals would be successful. The advice I've gotten from the former general counsels that we have working with us is integration really should start at the LOI stage. And part of that is because you have your finance team, your accounting team, your tax team, your legal team, your corporate development team. They're all focused on the deal. You may not have the business team, you know, the business unit as involved. The business unit may or may not be the integration folks, but you want them learning as everybody else is learning. Because if the deal closes, great, we learned all this stuff during due diligence, but the people that are doing integration, the business unit, may not know any of that stuff. And so you basically have another team picking up, okay, now it's our company. We got to handle it all ourselves. And this knowledge transfer that could have been happening, or maybe there's no knowledge transfer because they were listening in the whole time. And so they know what the due diligence team knows. A lot of our diligence findings in a particular deal may say, look, there's some legal non-compliance here, certainly not the end of the world. You will want to wrap them into your compliance procedures. That's fine, right? I think it's good for people to know that. That's the plan. But does someone have ownership of that? Have they thought about what's going to have to happen, right? What sort of policies do we need to promulgate, and to whom? And, you know, when do we need to conduct trainings and things like that? If that's not on people's radar, it could take a while for that momentum to get going, and could be 6 months before you actually get them onto your compliance plan for whatever the issue is. Some of the things I see serial acquirers do that I think is really effective is part of their diligence, whether it's in disclosure schedules, diligence reports, is saying not just tell me about your contracts, it's tell me about your contracts that come up for renewal within 60 days, 60 to 90 days of closing, right? So I know, hey, do I want to renew it? I got to make a decision really quick. Or do I'm worried that I got to make sure I do renew it so the other party can't terminate it. Is there intellectual property where we've got to renew, you know, filings quickly post-closing, right? That's more on the legal side. On the financial side, probably more of an issue for public companies than private, but relevant for everybody. when's the audit coming up? When is the next public disclosure going to have to happen? When do I have to take all the financials of the company I just bought, integrate them into mine? And especially if they're not on the same accounting standard or their internal controls aren't up to snuff based on what ours are, how much work is going to be needed to kind of integrate all that financial reporting? And you'll see some deals actually pause and they try to, the closing won't happen until the next financial reporting period starts to give the accounting team as much time as possible to kind of do all that ramp up. I'm sure Francois has been on the other side of helping folks recover from a lack of planning.
I'll just jump on that last point, Mark, and add a couple of others if you don't mind. But that last point, in one of my prior lives, our corporate development team came to us and they've been working a little bit in a vacuum. And they came to us and said this deal was pretty much baked. And by the way, it was going to happen on December 31st. And my accounting team lost their mind, right? Just completely lost their mind, right? Because they were in a position right now where they had to file and close and everything had to be done within the 45-day window. So it took everything and all the pressure to move it from a 12/31 deal to a January 1st deal. And like Mark said, it's just 1 day difference, but for the accounting team and the financials, vastly different result from how you report and how you've got to capture the information and everything else. There was the one thing I would also add on Mark's comments. We talked about how you're thinking about that pre-integration planning and everything else. One group to make sure you do keep informed is the technology group, the engineering group, if you've got a product group or whatever else, because if you're going to buy something and it's got to be, and you plan on integrating it, which is a question, right? Do you integrate? Do you integrate immediately? Do you wait a period of time? But if you're buying a company and you're going to integrate it immediately and it's part of some sort of technology play, then you've got to be able to make sure that your engineers, your CTO, your CPO, that they have got the capacity to be able to do that, because it's no good doing a deal thinking it's going to happen, close the deal, and then they're fully booked already on whatever the new product launch is or something else. They won't have time. And so suddenly you've got an asset that you can't integrate, or you do, and something goes wrong. And lastly, I'll pass it back to you, Roberta, but there was a comment I saw in the chat. Somebody said, it goes exactly to Mark's point he mentioned. He said, well, the startup's not going to get all of its compliance right and everything else, and they're moving at speed and everything else. Well, Mark, you mentioned it. It's like, as long as it's captured in the due diligence report where things are and where things need to be fixed, as long as you're planning for it in the integration process, Roberta, then that's when it will get fixed and brought up to speed. So it's not as though a startup has to get everything right. That's not the way it works.
And I think I'm gonna skip the next question, because I think this is actually the one that I'm going to ask right now is a little bit more in line with where we're going. And it's back to you, Francois, in terms of just what you and Mark were talking about in terms of integration, bringing in folks early, really making sure that they understand what that process looks like, bringing in those engineering teams if we're talking about some sort of technology play. But overall, and you've talked about this, both of you have, but if we can hone in on how do acquirers measure success of an acquisition, and what are those key financial metrics they want to track, and how do they ensure that acquisition will deliver ROI? And we all talk about that. Those are also 3 letters that I feel like everybody's talking about every day, but maybe it's just in my world. But I really want to get that answer out to our audience today.
Yeah, I'll start, and then Mark, I'll pass this one to you as well, because I'm sure you've got a ton you could add. And Mark, you already started down the path on this, which is firstly start early on this sort of integration thinking, at least, right? And a big where I start with that is when you're making an acquisition, one of the first things you've got to decide is what are you going to do with that acquisition, right? So you've got sort of 2 choices. Are you going to buy this thing and completely integrate it into what you do right now so that the name of the company and everything else disappears and it just becomes a part of what you are completely offering? Or Are you going to leave it as a standalone entity and it's going to operate because there's some benefit that you think of it standing alone? Maybe there's a brand name there, there's whatever, but you've got to make that decision very early on. And then everything you do after that comes from that decision, because that will dictate, do you integrate teams? How do you measure those successes? What are those KPIs? But once you've made that decision, then you're going to go down the path. And if it's this full integration, then a lot of it's going to be, some of those ROI KPI decisions is how long are you going to give the various teams to integrate? How long is it going to take for that technology to be part of your platform or that offering to be part of your offering? What is the headcount, right, that you're going to be looking at post integration, right? Are you expecting to just absorb everyone, or is there going to be some reduction in the number of employees overall? But you should be setting those goals and those KPIs and the timeline, especially for all of those things. Now, if you're going to leave it as a standalone entity, then that's a set of different things. Now, what you're probably looking for is some back-end efficiencies, backroom efficiencies, the back office efficiencies that you could create there. So then you're going to have to measure those, and again, over what period of time. But then, of course, if it's standalone, you're going to want to make sure that you've set the metrics for what you're expecting that business unit, because it now will be a business unit. What is the business unit results that you're looking for those things? And again, over what period of time? And Mark's mentioned it. Obviously, there's a difference between if the acquirer is private or public. But if you're public and you're making those things and you're going to leave it as a standalone entity or a standalone business unit, you're going to be expected to start to give out, your forecasts and your projections for what that's going to look like post-integration. So determining the strategy, determining what those KPIs and ROIs look like, headcount, revenue, bottom line results, cash burn, your normal type of things that, me and my world, we think about all the time. Those things are critical, and the timeline. Mark, I'll pass it to you.
Yeah, look, I don't have a ton to add because I think that's a great answer. It's being really clear about, why did you want to do this in the first place? Why was an inorganic, approach the right area, whether it's acquiring a product, whether it's growth, whether it's acquiring people, and how is that going to work? Why couldn't you do it internally, or why couldn't you do it internally at the right price or fast enough? And so what's the plan to kind of make that work within your organization? I will say that to answer the question a little differently, because our interaction, well, my corporate colleagues will often continue to work with the client, right? And so they've got some perspective on this, but it's not uncommon at all for me to come back to somebody if they've done their first acquisition, or we're talking about the second and the third. We start the second and the third, and I'll ask how that prior one's going, and you get sort of a wishy-washy response about, well, not quite as expected, right? And so I guess my point would be, I think Francois did a great job of answering how do you do it the right way? How do you do it effectively? I would just underscore the fact that it's hard. It's got to be really thoughtful. You've got to have a clear target. You've got to be constantly measuring it, right? You can't manage what you don't measure. And so a lot of times I find people very, very excited in the deal stage. Post-closing, it's sort of a little skepticism about whether it kind of worked out quite as well as intended. And so probably can't overinvest in, scoping that out and managing that process.
And the last thing I would add to that, Roberta, and this is more into Mark's sort of space on the legal side, is especially if you're going to be doing something that is an international, multinational deal, making sure you know all the rules, regulations, and laws, especially as it relates to employment in those various places, because you can set your goals. And quite often what I've seen is you set the goal and the timeline, and you set it as though it's one standard, one global standard. Okay, we will have decided within 30 days, and we would have actioned within 60 days the sort of the size of the workforce of the company we've acquired. And then you go to certain places like over in Europe, especially places like France and whatever else, and they've got this thing known as a workers' council, and it takes 3, 6, 9 months or so to work through before you can actually get to where you want to get to. So working closely with the lawyers on understanding all those rules is going to be critical.
100%. And that audience, that actually ends our panel part, but we're going to open it up for questions. We're going to bring Colin back on, and he's going to run our live Q&A. We're still not going anywhere. We're just opening up to questions for everyone.
Amazing. Well, thank you, Roberta and Francois and Mark. Always learn so much from both of you. So thank you for sharing some of those insights. We're just going to dive right into some of these questions. I'm going to start with this one, just because it's interesting. Under what conditions are unprofitable acquisitions worth pursuing? Francois, you were talking a little bit about your accounting department freaking out earlier.
Sorry, and Colin, the question was again, in what situation is an unprofitable acquisition worthwhile?
Yep.
Man, that could be, in my prior lives, a lot of the acquisitions we made were unprofitable in the sense that they were standalone entities, but sometimes we were buying the technology, sometimes we were buying the customer base, sometimes we were buying a geography. We needed to get into a market space and we just didn't have the right geographic footprint. And so the idea was we would go and make those acquisitions. And again, early on, we would think about, well, what is that value proposition as an overall company? And then on top of that, think about early on, what's that pre-integration, post-integration going to look like to drive to those results? But I do think, across the market right now, especially, there's still a lot of companies out there that are in that loss-making position, and the valuation is correct for them to be purchased. And one of the things we didn't talk about here is that sort of stock versus cash deal, and that does again influence what you're going to go after and how you're going to go after it and purchase it. But I think as long as you can come back to the point I made, is if you can quickly articulate in a few sentences the value of making the acquisition, then it's worthwhile going down that path, even if the company's loss making at this point in time.
I think that's great advice. Mark, you had talked a little bit about this earlier, but what are some of the key factors a firm should consider when selecting an M&A banker?
Sure. I think the first one is, like most advisors, personality fit is important. Not just personality fit, but does that person really feel committed to your deal? You have investment banks tend to work in sort of bands, right? Some of your biggest banks are generally going to be preferring to do deals in the maybe 500 million, $1 billion plus range. Other bankers will, and be in more of a mid-market space. There may be some small cap folks as well. So finding folks that does it make sense for them? If they're really far outside their range, it's a question of, why are they doing that, and just being confident that they're really, committed to your deal, that their style is consistent with yours, right? If you want to be really aggressive, are they really aggressive? If that's not your preferred style, are you kind of simpatico on that front? Industry knowledge is important. They're generally organized by industry with a particular focus on that. So somebody that is able to, know all the other deals that are happening in that space, know what metrics are important, what are the multiples that are being used. That knowledge can be really helpful. A good investment banker is incredibly valuable. An investment banker that's not as dialed in is a big transaction cost, without a lot of value. So I encourage people definitely to use them, but to, really feel like it's a good fit. You can always talk to folks that have used them on other deals to get some kind of background reference on their past work.
Doing your due diligence on them. I love that. Francois, question here on AI, and because I know that's the two-letter word that we can't, or two letters that we can't go at least an hour without saying these days. How are you seeing, or are you seeing AI being used for target screening, diligence, and valuation modeling?
No, the short answer to that is yes, I am starting to see this. Whether that's within the sort of the space of looking at you've got an idea, you want to check the competitor landscape. There's tools out there that are being developed for that. There are tools out there that are being developed that are looking at collecting all the information on valuations, both private and public and things like that, and being able to pull together almost like a catalog calling of information. Where I think it's potentially going to go is with the power of the generative AI is to then be able to say, well, what would the market look like in 6 months, 12 months, or whatever else? The technology is not quite there yet of the things that we're seeing. But just even yesterday, I was at an event where 40 different AI companies were presenting on their technologies. And there was at least 3 or 4 of them that were in this very space that I think, with further investment into those companies, they're going to get there. So I would say anyone who's looking and interested, it's going to be a space that's going to get the investment. It's going to become something, and it will become another tool that Mark, myself, and others who are in this space will start to use.
That's great. Roberta, you speak a lot to AI and cyber security. Any just like baseline considerations when thinking about cyber when implementing AI in your processes or company or all of the things?
I would just say, just like at a very top line level, you just need to be understanding that now just the tax and the things that are out there are getting much more complicated. And the ability to use AI to actually fight those AI cyber attacks is something that's growing across the industry. And it's something where it's actually become more valuable in terms of utilizing the tools to fight those types of attacks. And then learning from those, and then even further allowing your models to get stronger and stronger from identifying those. And then also too, from a customized perspective, understanding that even when you are using the AI within a certain environment, it is tailored to that environment. It's not just a general AI for AI purpose, like how it learns and understands a certain environment and a certain threat landscape for that environment is going to be totally different for another one. And that's from a company to company perspective. And I think those are some of the key things to think about.
Love it. Mark, Francois put you on the spot for this one, and I'm sure we could spend an entire hour on this topic, but can you talk a little bit about stock versus cash buying?
Yeah, sure. So those are just your two main forms of, how you're going to pay a seller for whatever you're buying from them, whether it's their whole company, whether it's some of their assets. Cash is probably easier to use, but whether you're a private or public company, some portion of the deal consideration or all the deal consideration could be in the stock of your company. Some of the challenges that come into that, those people are going to be on your cap table. They're now sort of your investors in a sense, and so you're going to have a longer term relationship with them than if you had just given them cash, right? And then you're not dealing with at least the investors in the target anymore. You've still got their employees. One of the biggest things that comes up in using stock is our tax considerations. Ideally, if you're going to give somebody stock and you're a private buyer, and there's no market for your securities, people are generally going to want to get that on a tax deferred basis, right? So they don't have to pay tax when they receive it, only when they sell it. Lots of complexity that goes into whether that's true. That kind of exceeds the time we have for today. You have more flexibility as a public company because you have a open market, liquid market for your securities. And so generally, if you give people stock in your company when you acquire theirs, they can turn around and sell that relatively easily. And so the tax considerations are less important because somebody can turn around and sell it, and they've got the money to pay the taxes.
Yeah, we could spend an hour on that same topic, I'm sure.
Yes.
Well, the other part to think about there, Colin, as well, and we didn't actually get to this, and Mark, this is something that you and I will deal with all the time, is what you just asked there, Colin, was a question about stock or cash for consideration. But there's also the question of what are you actually buying? And that's, are you going to buy the company and everything that comes with the company? So that would be a stock deal. Or for some reason, you may want to do an asset deal where you're buying the assets out of that company to bring them over. And that's got very different ramifications as well. So you've got two types of equations you've got to think about that some people sometimes get a little confused, right? One's the consideration, one's actually what are you buying?
Yeah, I think there's a lot there. So thanks for sharing. We are almost at time, and let me see if I can squeeze in a couple more questions. Mark, Francois talked a little bit about this, but you probably have a little bit more from a legal perspective on this. So what is the consequence when a seller has used non-US based contractors for building a major portion of their SaaS platform?
Yeah, sure. It's not something that's, immediately fatal by any means. It's just a question of like with any person that's developing IP for you, do you own it, right? Do you own it? Do they just give you a license to it? And part of the thing that one of the more common issues is that a company, a US based company, may use their standard form independent contractor agreement or other template agreement that's based on US law. A lot of the sort of default provisions around IP ownership and things like that. Okay, it's governed by US law, but you're using a contractor in another country. That law may, US law may not control there. And so it's a question of, does your contract work? Do the background principles of law in that company still make sure that you've got the IP, even if the contract's not perfect? And so then the question often becomes, can we get, if the assignment of IP is not sufficient from the buyer's perspective, then you're running around chasing people that are doing work for you now, that may have done work for you in the past, potentially having to pay them, some amount of money to sign a new agreement in order to make sure that the buyer is fully comfortable that the IP that they care about is owned by the company. It's more likely to, it creates deal risk. I don't often see it kill deals, but it creates a lot of stress on the seller side, right? When you're running around chasing people in countries where you may never have actually stepped foot, trying to make sure that you've got, all of that IP ownership buttoned up.
Yeah, great things to think about. All right, well, we're at that key takeaway moment. Francois, take us away. One thing that you want people to come away from this discussion with.
Do never underestimate the amount of work it takes to have a successful integration and have a point person for that integration.
Amazing. Mark?
I think there's a huge benefit in really preparing to do M&A long before a deal comes into view, right? And generally, I won't speak for Francois, but we're happy to work with clients. That's generally a sort of, how do we get ready for this in a way that's investing in the relationship and not the clock's not on, because we want to help people make sure they've got the tools and the vocabulary to hit the ground running if an attractive opportunity comes up.
Great. Well, we call it a boot camp for a reason, but you covered the bases on so many things. So thank you so much, Francois and Mark, for sharing your expertise, and for Roberta for leading such a great discussion.
Absolutely.
Thank you all.
Thanks, Colin. Thanks, Roberta.
All righty. Well, thank you all for attending. And if you want a follow-up meeting with any of our partners, fill out the next poll. But we really hope that this was a valuable boot camp for you all, and we look forward to welcoming you all back online soon. So have a great rest of your day, everyone. And thanks again.
Thanks all. Be well.
Bye, guys.